What is interest rate? Interest rates are the price of money, and they quietly shape almost everything. Your loan payments, your rent, your job market, and even stock prices. In the next 3 minutes, I'll give you the clearest mental model of interest rates, so you can understand what's happening when rates go up or down. What is an interest rate? An interest rate is simply what you pay to borrow money, or what you earn for lending money. But the deeper idea is this. It's the price of using money over time. If I give you $1,000 today, I lose the chance to use it right now. So I need to be compensated. That compensation is the interest rate. Rates also reflect risk. If lending is risky, rates tend to be higher. If things feel safe and stable, rates can be lower. Why do rates change? So why do rates move? Think about 3 big forces. First, inflation. If prices are rising fast, lenders demand higher rates because future money buys less. Second, economic growth. When the economy is strong, people and businesses borrow more, so the demand for money increases, pushing rates up. Third, risk and uncertainty. When fear rises, investors often rush into safer assets like government bonds, which can push yields down. Central bank and policy rate. Now let's talk about central banks. A central bank sets a key short-term rate, often called a policy rate. It's like the steering wheel for short-term borrowing costs. When inflation is too high, the central bank may raise the policy rate to slow spending and borrowing. When the economy is weak, it may cut rates to encourage borrowing and investment. But here's the key. The policy rate directly influences short-term rates, and it also influences long-term rates indirectly through expectations. Yield curve, short versus long. To see expectations, we look at the yield curve. The yield curve shows interest rates across different maturities, like 3 months, 2 years, 10 years, and 30 years. Short-term yields move closely with the central bank. Long-term yields reflect what the market believes about the future. Future inflation, future growth, and future rates. Sometimes the curve is upward sloping, long-term rates higher than short-term rates. That often suggests normal growth expectations. Sometimes the curve inverts, short-term rates higher than long-term rates. That often signals the market expects slower growth ahead. How rates hit real life. Okay, how do interest rates affect your life? If rates go up, mortgages and loans become more expensive. Credit card interest hurts more. Businesses face higher financing costs, and investors often demand higher returns. For stocks, higher rates can reduce valuations, especially for high-growth companies, because future profits are discounted more heavily. If rates go down, borrowing becomes cheaper. Spending may rise, and risk assets can become more attractive. So rates are not just a finance topic. They're a pressure knob on the whole economy. What to watch? Practical checklist. If you want to track rates without getting overwhelmed, watch 4 things. Inflation data like CPI, central bank announcements and press conferences, government bond yields, especially 2-year and 10-year, the spread between 2-year and 10-year, which hints at expectations. If you understand those 4, you'll understand most rate headlines better than 90% of people. Wrap. So remember, interest rates are the price of money over time, plus risk. Central banks steer short-term rates. Markets price the future through long-term yields. And your everyday costs, loans, rent, investments respond to that. If you want a part 2, I can explain bonds and yields in the simplest way possible. See you next time.